Good morning and welcome to the TPXIMPACT HOLDINGS PLC investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you up to Bjorn Conway, CEO. Good morning to you, sir.
Good morning and thank you very much. And thank you to everybody for attending this call. My name is Bjorn Conway. I'm the Chief Executive at TPXIMPACT. I've been here since October 2022, and my recent background before that, I was at EY, where I ran the public sector team and doubled that team size over a period of 5 years. And prior to that, involved in business transformation at PA Consulting. So if I can introduce Steve as well. Steve, would you like to say a few words?
Good morning, everybody. I'm Steve Winters. I'm the CFO, joined at the same time as Bjorn. I've been in the business slightly longer than that, working on finance transformation. Prior to TPXIMPACT, I was a long-standing member of the leadership team at WPP, latterly Deputy Group CFO, and prior to that, Group Chief Accountant. My job is very much around pursuing the operational and financial strategy of the business, balanced with our commitment, as I hope you know, to people, places and the planet.
Brilliant. Thanks, Steve. So we've got quite a lot to get through in the presentation today. There'll be a lot of detail and obviously questions at the end. But before we get into that, I just wanted to highlight a couple of key messages. So first of all, we're very pleased to be in this position. We've achieved or exceeded all of our financial targets for the last 12 months. And we've also managed to bring net debt down to 7.1 million, which is the lowest it's been for some time. And whilst doing that, we've managed to maintain the sort of integrity of the business, and particularly the strand that focuses, as Steve's just highlighted, around our purpose aspects, so people, places and the planet, and achieve B Corp accreditation. So really pleased that we've managed to do that in a balanced way. We're slightly ahead on our strategic plan. So as you'll see in this presentation, some of the simplification of the business and the grouping around natural operating models, we've achieved that earlier than we expected, because we expected to be doing that this year. So very pleased to have done that at the tail end of the previous year. And also, I guess the other positive highlight is the general election, which was going to fall in this year at some point, has actually fallen earlier in the year in the first half. Which leaves the second half clear. And our analysis, as I'll go through a bit later, in terms of looking at manifestos and certainly some of the early actions, leaves us well aligned with the sort of priorities of a new government. So the other thing remains to say as an overall view is that we're maintaining guidance for this year, both in terms of revenue and margin growth. So we'll go through the detail of the presentation now, and we're very happy to answer any questions at the end. So on this slide, you can see the targets that we had in the top left-hand corner for revenue growth, adjusted EBITDA and net debt, and the outcomes that we've achieved. So revenue grew to 84.3 million, which is 21% like-for-like growth. Adjusted EBITDA broadly doubled. And we achieved the middle of our guidance, which was 5 to 6%. So we achieved 5.5%. Net debt, particularly pleasing that net debt is down to 7.1 million, and Steve will no doubt talk about that more in a few minutes. And also in terms of new business wins, 139 million in the year, which gives us a good multi-year backlog of work. So really important to underpin the business longer term. As I mentioned a few minutes ago, achieving B Corp certification was really good for the way that we can show up with our clients, but also really good for our team members in the business. So it was a really positively and well-received thing. We've grown headcount, we've reduced associate numbers, staff retention remains high, and it's a clear focus for us to keep our staff engaged. And we've continued with our donating hours and also improving our ESG measures, which again, Steve will talk a little bit more about in a few minutes. In terms of revenue by sector, as you can see, central government is a significant portion of our revenue. So we'll concentrate on that a little bit in this update. And that sort of concentration increased a little bit with the disposals we made this year, because they were largely commercial facing organisations. So really pleased with those results. Just as a reminder of the business, we talk about people-powered transformation, and that's because a lot of what we do is focused on how people access digital services and access data and information. And the secret to our way of working with clients is very much dependent on the people that we employ and the way that they respond. We set out a 3-year strategy, and that was really to build an integrated platform for digital transformation. And you'll see when I talk through the simplified businesses how that comes into effect. The key thing is that for our clients, we're agile, we're responsive, we're coherent, we differentiate what we do. So we've got some great elements to our business, which came from the predecessor businesses from which TPX is composed. But we've brought those together in an integrated way so we can deliver all of that value and all of that benefit to our clients. And also with the development of the business, the intuitive business development, business benefit that comes out of that is that actually, if we're more coherent and we're more operationally mature, that will translate into better business results and also provide us with the basis on which to grow and develop the business in the future. So just to unpack the 3-year plan a little bit. So we really set out in the first year, we talked about focus and balance, and that was really about building commercial sustainability as a stronger element to the business in addition to the very strong focus on purpose. We intended in the second year to simplify the business and bring parts of the business together. And then in the third year to really use our differentiation around purpose plus improved commercial performance to really drive revenue and growth. And as you can see at the bottom right-hand corner, we talked about consistently trying to deliver 10 to 15% compound annual growth in terms of revenue, but also to improve adjusted EBITDA margins each year to get to 10 to 12% in FY26. So that is the plan that we're still following. The next slide will show us a little bit of what we've achieved in the first year. So in terms of operational highlights, so clearly the new business wins were really, we were very pleased with them last year, particularly the fact that they were long-term and also that they were very significant in size. So it really tested the business and we responded well in terms of being able to staff up those engagements and deliver them to a high quality to our clients. So a £49 million engagement there with Land Registry was far larger than anything that the business had won prior to that time. Simplified the business, and I'll talk a bit more about that in a few minutes, into digital transformation, manifesto and kits. We also, because of our strategy focusing on our core businesses, we felt that 2 of our businesses would be better under different ownership. So the Questers business and TPXIMPACT Norway left the group during last year. I was really pleased with the way that the team managed to do that very swiftly and cleanly. And it also contributed to us being able to pay down some of our net debt. So it was beneficial for the group as well. Steve and Luke are sitting in our new office, which has been a great impact for clients and for staff. It provides us with a much higher quality home for people to work in an integrated way, and actually to hold client events. So that's been a good move, and it's also helped us from an operational perspective as well. The B Corp certification is mentioned again. It's probably worth mentioning again because it's a really significant thing. I believe we were the 5th listed B Corp. There are now 4 listed B Corp. So it's quite a rare thing for an organisation like ourselves, and it's something that we cherish very strongly. The remaining points on here are really about just improving the maturity of the business. So making sure we've got the right sort of standards and ISO accreditations in place. We've grown the headcount and we're more efficient in the way that we balance our permanent staff and contractors. Our staff engagement has resulted in improved retention rates. So they're significantly up on a couple of years ago and are actually at a really appropriate level for our sort of business. So we're pleased with those that got to. And Steve will talk a little bit more about ESG performance, but broadly across the board, those results are really strong as well over the last 12 months. So we go on to the next slide, Luke. So look, in terms of the business structure, key to this was actually simplifying the business and making sure that we had businesses that operated together where we had common operating models. That's what underpinned a lot of the thinking so that we could show up to our various client groupings in a very organized and coherent way. So the major part of our business, representing about 75% of revenues, is digital transformation. The platform for that was the consulting business of last year. And what we did is we matured the operating systems and made sure the management team for the consulting business was performing well. And they then could take on the technical and data elements of Red Cortex, which was our Microsoft business in Wales, and also our data and insights business, which was itself comprised of 2 legacy businesses. So they've all come together under a single platform, single management team, and are operating as a coherent digital transformation business for our clients. Manifesto continued its journey of combining 3 agencies into a single agency. We also rebranded it as Manifesto because that had more traction with our client groupings and was distinctive from the digital transformation business, which was very, very successful and significantly larger. So it gave Manifesto a clear route to market. And our kits business, which is more dealing with large sort of payment systems, more legacy technology infrastructure, and really provide strong technology and architectural input and program delivery input, sits as a standalone business as well. So slightly different customer grouping to our digital transformation business. So with having the 3 businesses shaped in that way, it means we can focus on improving the performance of those businesses, supporting them during this year, and really helping them be very effective in serving clients. So talking about clients, we've got a couple of case studies here to just give you a really good view of what we do. So at our last presentation, we talked a little bit more about the Manifesto, the digital agency piece of the business, and we talked about clients like Breast Cancer Now and ZSL, who run London Zoo. Here we're going to talk a little bit more about our digital transformation clients. So a first example is that we have one of the largest user-centered design teams in the UK. And it's something that we bring to a lot of our clients, but what we also try to do is leave behind improved capability with our clients. So this is an example of working with the Department for Work and Pensions, where we used our user-centered design capability to help them build that capability themselves and to offer that as a service. So it's really the best use of their professionals that they employed in the business, supplemented by our own staff, to end up with a really professional user-centered design capability. The next example is actually one of our commercial clients, so a leading global bank. The bank had sort of been challenged by providing analytics around their people, so HR analytics around their global footprint. We provided a different sort of technology solution. It harnesses some of the principles of AI and provides the ability to answer unstructured questions and to actually share that information across the whole group. So it's a group of about 250,000 people. And through using these systems and using this slightly better way of accessing information, they anticipate saving around $10 million over 5 years. So really produces a very tangible outcome from the work that we've done. And then the final case study goes back again to our focus around people-powered transformation. So putting people and users at the heart of what we do. And this is about electronic patient records in the Department for a Health Trust. And here it's really about understanding the needs of users and making sure that we're designing the pathways in terms of how people access information and how people move through the department in a sort of user-centered way. In terms of those are the case studies around our digital transformation business, which, as I said, represents about 75% of our business and is also very focused on public sector, but also growing in the commercial area. You can find more details about those case studies on the slide pack. As you can see, there's an arrow there where you can click through to the full detail if you want to read more about them. I'm going to hand over to Steve now, who's going to pick up on some of the financial and ESG aspects. Over to you, Steve.
Thank you, Bjorn, and good morning, everybody. So FY24, as we say here, was a year of recovery and growth, really trying to build a foundation for future success and continued growth. Our revenue was 84.3 million, which, as Bjorn highlighted earlier, was up 21% on a like-for-like basis. These numbers are largely, if not entirely, all like-for-like, so they exclude the Questers and Norway businesses from the prior year comparatives. I would also say there is an appendix at the back of this, which we won't cover, that has quite a lot more detail on P&L, balance sheet and cash flow, which you can read at your leisure. At the present time of our FY25 revenue target, around 70% or so is sat in backlog and represents committed revenue. Last year, our profit doubled on an adjusted EBITDA basis to £4.6 million, which equates to a margin of 5.5%, which is bang in the middle of our range, our target range of 5 to 6%. On a reportable basis, we made an operating loss of £22.8 million, largely due to goodwill impairment in relation to our Red Cortex business, which I'll show you a bridge of our adjusted to reported numbers shortly. Adjusted PBT more than doubled to 1.8 million, as did adjusted diluted EPS to 2.1 pence per share. The balance sheet was a pleasing end to the year with net debt of 7.1 million pounds, which is the lowest level of net debt in over 3 years in this group. Our gross borrowings, so the amount of the banking facility that we've drawn down, decreased from 24.5 million pounds a year ago to 16.2 million pounds at the end of March 24, and has since reduced further to 12.2 million pounds, as we've effectively used the proceeds of the disposal of Questers, combined with our operating cash flow and a very successful working capital result for the year. As throughout of that free cash flow, we've used it to pay down debt and therefore, in the short term, reduce interest costs in the coming financial year. Here's a little bit of information on the revenue and adjusted EBITDA trends, again, like for like over the last 3 years, growing from 69 to 84 million. In terms of our target for FY25, the current financial year, we've stated a target of like-for-like growth of 10 to 15%, which would put us on or around in the range of 92 to 97 million pounds or so. In terms of profitability, again, our target is 2 to 3 margin point improvement. So on top of the 5.5% achieved in FY24, we're looking for a margin of 7.5 to 8.5% in the coming year, which would equate to somewhere in the range of 7 to 8 million pounds in absolute terms. So a very healthy trajectory. In terms of how that revenue growth is phased over the last 2 years, very significant growth in Q2 and Q3 of the year just gone, largely driven by those large contract wins with Land Registry and DFE, reaching a peak of 38% growth in Q2 and 21% for the year as a whole. The final quarter was 11%, and the first 2 months of the current financial year are very much in line with that run rate at 11%. Thinking about how the coming year will pan out, we have said in the release that we expect growth and profitability to be weighted more than usual to the second half of the year, really a symptom of the timing of the general election that just happened, which we expect to impact revenue, particularly during the summer months, and then pick up again and accelerate in Q3, largely driven by something we also talk about in the release, a very healthy, indeed robust pipeline of current opportunities for the business. In terms of that bridge from reportable to adjusted numbers, as I said, we took a significant impairment of goodwill and intangible assets, mainly in relation to Red Cortex, which is that 16.2 million pounds, the vast majority of it in the blue bar. Non-cash, there is no goodwill in relation to Red Cortex going forwards. This dealt with everything associated with that. Amortization and depreciation of 8 million or so. The vast majority of that number is the amortization of acquired intangible assets on previous acquisitions. A relatively small amount is depreciation of capital expenditure because we spend very little on CapEx in any given year. Transformation restructuring costs of 1.4 million largely comprises 2 or 3 things, which is costs associated with the property move to the Hickman in the middle of last year, some spend on IT projects and systems development, and some costs in relation to selective restructuring activities within the business. Share-based payments of 1.4 million is in relation to share-based plans that were awarded at the back end of the previous financial year, and this is the full year impact of that, and we'd expect this to be the run rate pretty much going forward. And adding all those things together brings us to the adjusted EBITDA number of 4.6 million. In terms of net debt, here's a bridge from the start of the year to the end. Cash thrown off by operations of 3.5 million or so is really the EBITDA number, reduced by the cash we spent on transformation and restructuring activities I just mentioned. We had a very productive working capital improvement during the year of over 3.5 million pounds. We have a very healthy balance sheet. Our debtor days are 43 days, and the vast majority, indeed well over 90% of our receivables, are either not yet due or less than 1 month overdue. So a very pleasing outcome, particularly towards the second half of the year. Gross disposal proceeds of 7.5 million was cash received in respect to the disposal of Questers in the middle of the year. Coming off that is the cash on the balance sheet that was deconsolidated as part of that transaction of 1.5 million. Interest payments were 2.2 million during last year, driven by, initially at least, high borrowing levels and relatively high interest rates. Over the course of the year, we've renegotiated, as I'm sure you'll have read in a recent release we did about a month ago, we've renegotiated our debt covenants to a more normal profile going forwards, and we paid off net debt, paid off gross borrowings, which will impact the interest charge in the coming year and reduce it to not quite, but almost half that amount is our expectation. Other outflows largely relates to lease payments during the year on long-term leases like the Hickman and Chesterfield. That brings us to a net debt number of 7.1 at the end of the year. Onto ESG, and as I said at the start, a large part of my responsibilities are in relation to these priorities for our people and our clients, and that's very focused on people, places, and the planet, whether it's our engaged workforce, the communities that we work with and around, and indeed our carbon footprint. In terms of how we, in terms of how we met those priorities during the course of the year, clearly the most important achievement, as Bjorn has mentioned, was the certification of B Corp, which happened in January, which is a very important milestone for the business. Reading across from left to right, our headcount totals just almost, not quite, 670 people at the end of the year, of which about 133 are associates or contractors, and 533 are full-time employees. That full FTE number is at 9% like for like against a year, and the contractor number reduced by about a third over the course of the year, reflecting a better mix, a more efficient mix of staff resource. Our representation numbers, both by gender and ethnic minority, improved slightly over the course of the year. Our gender pay gap improved to 8% from 14% the year before, and indeed 20% the year before that. So a marked improvement on that. Meanwhile, our ethnic minority pay gap increased from 8% to 15%. Still work to do in this area, largely a function of fewer ethnic minority representation in the leadership group. On the bottom left, you can see our carbon intensity statistics. On a revenue basis, 15.3 tons per CO2, and per an FTE, 2.45. That revenue number is 15% better than a year ago, and the FTE figure is 11% improvement on the prior year. And in the bottom left, as Bjorn already noted, the hours donated in terms of volunteering and other activities by our workforce increased somewhat to 2,738 hours. Back to you.
Thank you very much, Steve. So if we talk again a little bit about the market, so We operate obviously within the UK software and IT services sector, a very, very large market. And despite the fact that we're growing pretty rapidly, we're still a fairly small component of that. So we don't see a limitation to the business in terms of the size of the addressable market. Just probably worth running through how we see different parts of the market. So the public sector, clearly the election has been the major thing that has been dominant in this year. As I said earlier, very pleased it's in the first half. Very pleased that it's been through, and we're starting to see real activity from the new government in terms of their focus and where they're pushing on. Very closely aligned with what we do. So planning and infrastructure, a core area that we're involved in, transforming government, health and social care, clearly the whole digital transformation landscape, and also the way of engaging communities. So citizen engagement is a key aspect of our business, an area of strength. So we actually see good opportunity there, and that's sort of borne out in our pipeline currently. So we're seeing more larger opportunities in our pipeline looking ahead. In the private sector, we gave an example there of our work with a global bank. Our approach to market in that area is really, for example, that global bank, we are really, really deep in one very small part of the bank. So in the HR community around data and analytics, clearly there are, in an organization of that size, there are many more opportunities for us to add value. So it's about networking across those existing clients where we already have contact. But it's also about facing off to the private sector. We have sector-facing teams, commercial sector-facing teams in both digital transformation and manifesto. And particularly in manifesto, one of the unique differentiators for us is around the accessibility of the websites and other interaction capability that we provide, and also the sustainability of those. So we can provide a sort of differentiated proposition into that market. At the bottom there's a comment around responsible and ethical generative AI. It's a topic that gets talked a lot about at the moment. I think in previous updates, I sort of said that there was a huge amount of interest, but budgets weren't really in place yet. I think if we look about that, there's still a huge amount of interest. Virtually every event talks about AI. We have some big events coming up later in this month, and again, focused around AI. The key thing there is that a lot of people are trying to understand what's going on, but we would expect to see budgets, particularly in the public sector, start to come into place probably over the next few months. Notable that some of the announcements in the last few days about bringing together CDDO and GDS and AI into one common area in a department called DSET in central government, and also appointing people like Patrick Vallance, which really sort of echoes that move towards more data-based sort of policy making and decision making in government. I think those will all be really good for us and will create opportunities for us to use that skill set more broadly, and we'll put the budgets in place. Finally, sort of on the third sector, really important, particularly for our manifesto business. We've seen over the past year, 18 months, 2 years, that donation and funding levels have been under pressure. A lot of what we do is about improving accessibility and improving engagement, both to donors, to supporters, to people who operate in those organizations, and also people who benefit from them. So we provide sort of digital transformation and improved accessibility for all of those groups. So we see ourselves as part of the solution. The market has been tougher in that area in the third sector, but we do see an opportunity to add value going forward, and an opportunity for that particular business and also the digital transformation business to succeed in the third sector. So if we go on to the next slide. So just thinking about current trading and outlook, I mean, the important thing is we've reaffirmed our targets for this year. So we are expecting to achieve 10 to 15% revenue growth and to improve our margins by 2 to 3%, as Steve has highlighted on the previous slides. We've had a good start to the year. Our pipeline is looking busy. We obviously have, like any other business operating in the public sector, things slow down during an election period, which is why it's really beneficial that that's happened in the first half of the year. So it leaves our second half a little bit clearer. We're in a much more sustainable position in terms of our gross borrowings and our net borrowings, so it reduces things like interest costs, which Steve has talked about, and really pleased that we've also got a new agreement in place with the bank, which is really well suited to our future needs. In terms of looking forward, we've got a good backlog of revenues, as you might expect. We've got differentiated offerings which seem very strongly aligned, particularly with in the public sector, with the sort of things that were in the Labour manifesto and we're now seeing put into place in government. So we think we're very well positioned for at least the next 2 to 3 years, when the government is going to be very active in trying to pursue some of those ambitious policies. And as a business ourselves, we remain agile and responsive to the market. So we've got good bidding mechanisms in place. We can identify opportunities coming up. We can match them with our people, and our internal processes have moved on quite a long way over the last 12 to 18 months. So maintaining our targets for this year, and more importantly, looking out for the full 3 years of our 3-year plan, we're expecting to continue that growth, 10 to 15% annual revenue growth, and also to improve our margins to get to about 10 to 12% adjusted EBITDA margins. So that's the core of the presentation. So it concludes the formal part of the presentation. We're really happy to answer any questions, and I'll hand back to Mark. Thank you.
Perfect, Bjorn. Steve, thank you very much for the presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated in the top right corner of your screen. But just while the company take a few moments to view the questions that have been submitted today, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received questions throughout today's presentation. And Luke, if I could just hand over to you to read out the questions where appropriate to do so, I'll pick up from you at the end.
Sure, thank you very much. And thank you for your questions. Bjorn, Steve, so with over 90% of FY24 revenues from public service clients, what is your plan to diversify this, especially in the private sector?
Yep, shall I lead on that one, Steve?
Yeah, go for it.
Yep. So public service includes third sector as well in the way we define it. So public sector is about 65% of our revenues. And we do plan to diversify, but actually if you look at the change in government and the opportunity that presents, we see that public sector providing a lot of opportunity over the next 2 to 3 years. So we see that still being a really strong part of our business. In terms of how we sort of support the other sectors that we're involved in, what we've put in place over the last few months is we've put in clear sector strategies and the teams behind those. In our digital transformation business, for example, we have sector strategies for the commercial sector as well, and also for the third sector. So that involves teams looking at what we do really well at the moment, where we can deepen those relationships and where we can take that capability into new clients and put plans behind those. And similarly in our manifesto business, we also have real strength in charitable clients, in museums and attractions. So some of the examples we talked about when we last updated, and they also have a commercially facing team because they do work for commercial clients. And as I said, we've got a bit of a unique proposition there around sustainability and accessibility of things like websites and ways of contacting people. So our plan is to clearly maintain focus on central government, because that's where there really is significant opportunity and very, very large engagements to win, but also to make sure that we're building those relationships and building that work, particularly in the commercial sector over the coming months.
Thank you very much, John. We have a couple of questions here from George. Great presentation. 2 questions. Does DX pivot to AI on pipeline opportunities? Are you starting to monitor training hours, and is this impacting utilization, or will AI be delivered via subs or M&A?
Okay, shall I pick that one up again? So thanks for the question, George. So we already monitor training hours. So we monitor all areas where people are busy doing things, whether it's directly for client work or other things. What we're seeing really is that we'll apply the same principles as we apply to all of our work, which is where we think we've got repeatable skill sets that we're going to retain long term. We will invest and recruit permanent staff into those roles, or train up permanent staff. Where we think it is really niche specific expertise, we will buy that in, if you like, through associates or through subcontract relationships. Certainly in terms of AI, we already have a good grounding in certain parts of our business around AI. We actually have a workforce who are very keen to learn and are agile and kind of build their understanding. So that's a really good place to start as well. So at the moment, it's more about taking the capability that we've got and the insight that we've got to clients. But as that turns into, as I explained, there's more money behind it, more budgets behind it, we will inevitably build those teams. So we will recruit into those teams where it's building that long-term capability, and we'll work with partners and associates where it is sort of point input, or we need to ramp particularly quickly. So I hope that gives you a bit of a flavour as to our approach. I mean, we see a lot of talk, a lot of interest, and we see that turning into more definitive and larger projects for organisations like ours over the coming months.
Thank you, Bjorn. One for you, Steve. I think this is a pretty quick answer. Well done on the B Corp. Thank you for the ESG disclosures. Does ESG report into you?
Okay, so we have an ESG committee which is reports to the board and has representation from both non-executives from the board, myself, and a number of leaders within the business. The ESG on a day-to-day basis, the head of purpose reports into me, and we manage our priorities accordingly. But strategy is really set by the ESG committee as a subset of the board.
Thank you very much. A couple of more questions coming in now. So, profit expectations 7.5 to 8.5, structurally lower than they were in 21, 22, where they were double.
I think the business has changed a lot over the course of the last 2 years. We've invested in the centre to support our businesses in IT and operations, and really bring what was a group that comprised a large number of separate businesses operating independently to something that is, as you've seen, effectively 3 businesses operating in a much more integrated way. That has required an investment in central resources, I say, but also to demonstrate greater governance and control, as you would expect from being a listed company. So I think our strategy is to continue to grow that margin over the course of the coming years. You'll have seen the 3-year FY26 objective of 10 to 12%, which is more in line with, I think, what you would expect of our competition as well as ourselves.
Yeah.
Thank you very much. Some questions here, a bit more specific. Are there any conditions that you would consider reinstating a dividend payment?
Okay. As we said in the release, dividend policy is something that we do review at a board level on a regular basis. Obviously, given the financial challenges last year, it is something that we took off the table at that period of time. Right now, we're in a better position from a net debt perspective, as you've heard. We said in the release that in terms of going forwards, our use of cash flow will be primarily to either pay down debt, continue to do that. Obviously, we've made good progress on that in the last 12 months, or invest in shares for our EBT to fund incentive schemes that were granted a couple of years ago, and potentially in the medium term in M&A. Dividends are part of that conversation, but I'd expect the first 2 elements, repaying borrowings and purchases of shares into the EBT, to be a priority in the second half of this year. And then as free cash flow opens up with continued profit growth and cash generation, it will make that conversation around dividends something that's more appropriate, potentially, in the medium term.
Thank you. There's been a question around our share price, and I know it's very much down to the market, but do you have any thoughts regarding that at the moment?
My thoughts about the share price are primarily we focus on the business and making the business better. We continue to meet our goals consistently and predictably over time, as we've clearly laid out in the 3-year plan. And I think that is the element over which management have control, the strategic direction of the company. You may have seen some of the supportive notes from analysts this morning as a result of our prelims. We believe, like many people, this company is undervalued, but by delivering on our promises, we feel that that is the best way we can go about continuing to support growth in the share price over a period of time. But our focus is very much on that growth trajectory of both revenue and profitability and margin improvement, as well as managing debt in an appropriate way, as I said.
Wonderful. Are there any more questions that anyone would like to submit?
We've got one about Kainos. Happy to answer that one, if Luke, if you've got that on your screen.
Yes. So note Kainos has seen a decline in public sector revenues of 6%, but they're showing a high GM of 38% versus revenue 25% for us. How do we catch up? That would add circa 10 million of profit. So kind of a question around GM. Yeah.
Do you want me to take that, or do you want to take that? Yeah.
I don't mind if you want to start initially, Steve.
I'll start. It'll be a conversation. Gross margin. First of all, our gross margin declined in the year just gone from 27% to 25%, and there were two major reasons behind that. One is the issues we referred to at Red Cortex, and the second issue is we were obliged by virtue of some of the large contract wins with central government last year to maintain a third-party partner, or subcontractor, if you like, to help service some of the government work that we want. That when you engage a subcontractor like that, you inevitably has an impact on margin. Now, over the course of time and looking forwards, we would expect, as our capabilities and scale continue to grow, that desire to engage on third-party partners would reduce, and that will in turn improve to some extent gross margin. More importantly, in a way, is how we are managing our resource. You've heard us talk about the mixture of firms and contractors, which is currently around 80-20 proportionally versus a historic rate of around 70-30. That creates efficiencies and cost savings as time goes on. You've heard about our retention rate of 88%, which ensures that permanent headcount is more likely to be committed to the business. 2 years ago, that retention rate was more like 75%, so quite a dramatic improvement over a relatively short space of time. At the same time, we are managing utilisation rates very carefully. We saw some improvement in that over the course of the last year, and the tooling that we have, the systems in place to manage the predictability of resource requirements has continued to improve, although I think it's fair to say more investment is required. So I think in terms of our own group, a target of, let's say, a 30% gross margin is achievable in the medium term. It won't happen immediately, but we have the tools in place to achieve it. I'm not convinced that Kainos is the right comparison for us, given, for example, the work they do on Workday. It's not quite the same thing as our user-centered design sort of priorities. But I think 30% GM, this business has achieved that in the past, and I think in the medium term, that's certainly something that we're aiming towards to support our 3-year objective of that EBITDA margin of 10 to 12% that you saw in the strategic objectives. Do you want to add anything to that, Bjorn?
I think you've covered it really. I mean, the only other thing to add is the market piece, which obviously we don't really know what underpins the statement around the decline in public sector revenue, but we're going through an election period, which is often a difficult period. I think sort of longer term, our outlook is very positive, and that's really the nature of the work and the way it aligns with what we do and do very well. So I think the public sector is a good place for us, as I say, particularly as we go through the first few years of this parliament, where I think we'll see lots of opportunity. So we still need to win it and convert it and deliver it, but I think it's going to be a good environment.
Perfect. Bjorn, Steve, Luke, I might just jump in there and thank you for answering those questions you can from investors. Of course, the company can review all the questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Bjorn, could I just ask you for a few closing comments?
Of course. Thank you very much. But first of all, thank you very much for attending the call. We really appreciate the questions because it helps us understand what's important to you. So we really appreciate those, and we hope we've answered them well. As I said at the beginning, highlights for us are we've managed to achieve the targets of last year, make the progression in the organisation, so accelerate some of the simplification that we were trying to do, but remain true to what differentiates TPX Impact, which is around that core of purpose, as evidenced by the B Corp accreditation. So really, really pleased with that outcome. And as we look ahead, I think our alignment with what the new government is talking about, because public sector is such a large and important part of our business, it does provide opportunities ahead, and we're seeing that in our pipeline at the moment. So I think that's really encouraging. I'm very pleased with the effort that the teams have put in. They've really come together well. Our people have performed brilliantly, and I'm really looking forward to the sort of next 2 to 3 years ahead of us. I think this could be a really exciting time. So thank you very much for your time. Thanks to Steve and Luke as well for contributing, and we look forward to updating you soon again.
Perfect. Thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of TPX Impact Holdings PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.